When a very small company comes to us, we tell them that, hey, can you do it yourself in Excel, or, we will give you we'll show you how to work in QuickBooks. Sometimes people, suddenly the CEO comes to me and says that this guy has, applied for an IP and it is similar to what we are developing and he is working, he's an employee.
Do not give any promises that you cannot track. And if you want to give promises, document them. It's as simple as that.
Hello, hope all of you are well. As you are aware, Wai Involve is a Wai Technologies initiative to help founders, CTOs, and engineering leaders to imagine and build their products. So today's session is a 101 lesson to setting up and managing your business entities. It will help you understand the basics of your business setups. It gives you all the tools and techniques that help you bring your ideas from your mind to reality. This session is our attempt at making setting up and running a business less intimidating. What's inspiring about today's episode is that both of our guests are not only seasoned professionals but also entrepreneurs in their own regards. They walk the same path to build their own business, navigating the messy, uncertain, and often overwhelming process of building a company from the ground up. Our first guest is Tanmoy Chowdhury. Tanmoy is based in California. He's a respected figure in the startup ecosystem, an accomplished finance professional with deep expertise in strategic financial operations, funding, and growth management. Tanmoy currently advises over 100 different companies, has supported 11 merger and acquisition transactions. Some of these transactions have been as big as $500 million acquisitions by public companies. So if you're thinking about financial planning, financial operations, investor readiness, and scaling up your operations, Tanmoy is someone you want in your corner. The other guest, and we're proud to have him on the show as well, is Mr. Shridhar Kulkarni. Shridhar is a seasoned legal expert who specializes in startup advisory, corporate structuring, and compliance management. Shridhar has helped dozens of early stage businesses establish solid legal foundations, manage co-founder dynamics, protect their IP, and stay compliant with India's evolving regulatory environment. So Shridhar and Tanmoy, thank you for joining us today. Welcome to the show. Let's start at the beginning. Founders often focus all their energy on building the product and generating revenues, but they soon run into what I call non-core but mission-critical issues like entity structure, shareholding, funding, compliance, banking, payroll, contracts. So if you're sitting across a starry-eyed first-time founder, what are the absolute first-day must-haves you would recommend to set them up for long-term success? Tanmoy, if you want to go first.
Sure. I will leave the legal part to Sameer, but any person starting a startup or even a small company, whenever you're starting, he or she, at least in US, the first thing is to incorporate the company. Now, there are different states you can incorporate, but obviously if your ultimate aim is to raise money to grow your company, then most of the investors prefer Delaware as a state. However, one must realize that if you are not in Delaware and you are, taking from the company or you are representing the company as the CEO, then that particular state also needs to be registered as a state where you want to do business. So that's important. So if I'm in California and I want to start a startup, I will start with Delaware if I'm going to raise money, but I have to also register myself in California. So that's the basic first thing. Once that happens and you can decide on C Corp, S Corp, basically corporation or limited liability company. Obviously, if you want to raise fund, it has to be a C Corp because it's not has to be, but generally investors will give you money only if you have a C Corp. Once that happens, then you go ahead and, get your EIN number, which we call it employment, identification number, which you can get it from IRS or, otherwise also there are other entities who can, liaise with IRS and give you. Once these two things happen, you need to open a bank account. Once you have your bank account, once you are registered, once you have, tax ID, you are ready to roll. You can start working. In US, it's not necessary that you need to have an office. You can work out of garage. We have a lot of examples. But other than that, Now, the point is that if you're a one-man show, if you're bootstrapping, then you may or may not need to go to the next level. But if you are a startup starting with fellow, couple of guys, again, if you want to raise fund, etc., then you need to have a share agreement. You need to have an option agreement, and you need to have all those legal paraphernalias also to get in place. And then, however, it doesn't stop you from doing business, but because it does take time, right? I mean, obviously the attorneys, they will have their own questions and they will ask them, and but those are important because whenever you want to raise money, you will be asked, or you'll be asked that whether you have all those agreements on. There are certain additional thing, like if you want to put someone into payroll, now which payroll services you want to take, then you have your payroll, which payroll services you will take, and then you have certain state-wise, federal-wise requirements, compliances, and I will leave Shridhar to lay out those things in detail. And the other big thing is that you have to do at the end of the year, you have to do a tax return for your state as well as federal. First year, generally it's a short tax return we call, because it's not for whole 12 months, but after that every 12 months. But I will stop there because we are talking of just a company which is starting. Obviously there are other things as you get into 3 months, 6 months, 9 months in your journey, but I'll stop here and I will let Sameer you talk, and maybe Shridhar can add.
Sure.
Yeah, sure. So I would want to talk a little bit more on a structural must-have first 5 things that come to my mind when anybody starts or works on thinking about starting a startup. And while you might have the whole soul with you, you need to have the structure and the systems without which you can't survive. And the best 5, I think, is one is which is already addressed by Tanmoy, which is the nature of the structure or the entity structure. I'll talk more from the India perspective because I think we are going to touch base upon a point where where to base out, whether in India, whether in US, whether in Singapore, So from an India perspective, we always suggest that if you are going to get into a business mode, then look at limiting your liability. And that actually decides the structure of the entity structure with which you will start your business. There are 2 primary structures in India, and which is, I think, also supported by the US law structure, is what Tanmoy mentioned as the C Corp, and in India it is typically the private limited company or the limited liability partnership. Limited liability partnership as a structure has little bit of limitations from an underlying unit or a structure as far as the equity is concerned, because ultimately we are looking at a cap table which should demonstrate the whole ownership structure. But nevertheless, from a limited point of conversation on the limitation of liability point of view, the private limited or the limited company structure and the limited liability partnership are 2 different entities that are typically formed in India, and I believe similar such structure exists in the US as well. The second best point is, I always give this example, is that when the tree is small, when it is not bearing fruits, no one is giving attention to it. But the moment it starts giving fruits and the fruits are ripening, you will have stones thrown at it. So from that perspective, I would always suggest that draw the rules of the game, especially when you are 2 people, not 1 person in the game. Draw the rules of the game in the form of an agreement, which we would typically call as a founder agreement, and decide ABCD things into it, right up to. So as lawyers, we are taught and trained to think negatively first. So look at things that could go wrong and try to cover them up in the founders agreement, even if it is between friends. So as I said, over a period of time, things change, scenarios change, horizons change, and therefore the mindsets also change. And we have seen a lot of issues where people who said that we are friends, when they go down the line and are mature in the business, and when there is something to reap out of it, because of no understanding as to what happens when there have been disputes. So the second best thing that I would recommend is to have a proper founder agreement drawn between whatever name called, but have the rules of the game decided. The third point that I had was about the cap table clarity. By that count, yesterday I was on a call with the founders who wanted to have a new structure built. They have been working together for the last almost 15 years now. but they wanted to have a cap table clarity because they are going to get into a new venture, a new startup, and they had not only the founders working for them, but they had plans that there would be partners who would be working with them and also the employees who would be working for them. So you should have a cap table clarity from day one. How much is that the founders are going to own? How much would they want to dilute to the executives or the partners whom they would want to have the skin in the game, and then eventually the employees. Do not give any promises that you cannot track. And if you want to give promises, document them. It's as simple as that. And you need to have a little bit of a math in your mind very clear as to what you would want to mean by a cap table. And of course, there is a legal aspect to it that until a certain point of time, do not let go the majority voting power from the founder's hands. And this is not something which is a rocket science, but I would strongly recommend that you should have the veto in your hand until and unless you feel that the startup is on an auto mode. The fourth point is a very important thing, especially when you are into IP creation mode. Decide that the IP will be with the company and not in the name of individuals. Assign it on day one, and so that there is clarity and it does not, and the IP does not sit in the personal name. And the last thing that I would say is basic contracts, basic documentation, be it customer, be it people, that is your employees. And of course, as I mentioned, the first part is about the co-founder agreement. That also is a contract. You should have simple documents, not to make it too complicated. Volume of the document does not mean that you have everything. A single pager document also would cover a lot of things, but you need to have the discipline of creating a written documentation for each and everything. So these are my 5 basic points that a startup or a founder of a startup should think about, and it does not need too much of efforts and money.
Understood. So, and that's beautifully laid out, right? So from a finance perspective, Tanmoy, you talked about EIN, the type of company you want it to be, create the bank accounts, focus on or think about the state you want to register. So usually 2 items come up there, and Shridhar, you touched on it also, the S Corp versus C Corp, or as you called it, the partnership. The key factor you said is figure out if you want to limit the liability or not. So Tanmay, that, and the second is usually in the United States, the state of incorporation. Typically Delaware is common, California-based companies sometimes prefer California. So can you talk a little bit about just those 2 points and what are the considerations that go into one or the other?
See, in US, let me break the company structure into 2. One is the incorporation and the other one is limited liability, company. Now, let me explain you why investors likes a particular structure over other. In case of limited liability company, what happens? In US, you don't get a lot of tax benefit unless you are filing the tax as a partnership. You can continue to work as a company, you can issue stock, you can have your options, etc. But, you start getting benefit if because, the income comes into the hands or the loss comes into the hands of the owner or the partners, correct? The issue with venture capitalist or, home office or even high net worth individual, what happens is that they also get investment from LPs, they call it like limited partners. So they have to issue lot of, K1s, we call it like, partnership income or, loss or whatever, that particular tax form to all these investors, their investors. Now, if as a LLC, if I file tax return, then I have to also create the same K1 and we have to give it to those venture funds. And then those venture funds have to add those things into their income or loss and they have to again issue. So it's a bit of cumbersome because, think about it, your venture fund is investing into 50, suppose over a period of time, 50 investments. So if everybody starts doing LLC, then, they will get 50 K1. Nobody likes that, right? It's a lot of work, a lot of, so that's why they try to get out of LLC. Now, then you have your incorporation, right? So it's C Corp or S Corp. The issue with S Corp is that the tax benefit between S Corp and LLC is similar. So you can basically create a, tax return which can go, flow through the investors. But the other issue with S Corp is it cannot issue stock to any shareholder or to any employee outside United States. Then ultimately it becomes C corp.
So a US entity that's, for example, hiring people in India cannot get the
Right, sure. We should stop to the. So there is a concept called phantom shares. That way they issue, but reality is that phantom shares are mostly like a kind of quote unquote bonus. So it's always taxed at a income tax rate, not at a capital gain, and that's why C corp is important and expected, and people like C corp more for these reasons. Now, obviously, if you are if someone is starting a company as a bootstrapping, or they know that they are not going to issue shares outside US, or they were saying that okay, even if I issue shares outside US, but the main owners are only 2, 3, 4, or even a small handful number, and then the options that you are creating, those options are there is a category or B category, call it A class options, B class options, where B class doesn't have a voting right, or they cannot participate into the yearly profit or loss. So those things are there. So if you can create that, and you don't have a lot of investors, and you don't want to, or you don't expect to take a lot of investments, then I think LLC is a great option, because the main 3-4 guys who are the main investors can LLC income or LLC loss can flow to them, because all other shareholders, whether they're in India, they're in Africa, they're in US, they can issue, they call it option unit options. They can have it at the same time. They don't need to they are not participating in the annual profit or loss. So basically you don't need to issue so many K1s. So that's the thing. Obviously, for a shareholder outside US, there is a certain tax law, there is a certain tax deducted at source law in US, but that is only when the company is getting sold. So it's whenever it gets. So there's a few years. So that's the other option.
Got it. So a lot of different considerations, I think, in terms of what is your exit plan, if you're going to sell to investors, how much control you want to keep, so on and so forth, that can make it simpler or complicated. And that's where I suppose they should, or a founder should, talk to a finance expert when they set up the structure, because it's hard to change from a C Corp to S Corp or an LLC to a incorporation later on. So the earlier you solve for it, the better it is. You don't have to revisit these conversations later.
Yeah, I mean, S to C, I feel okay, but what happens is that when if you're changing company to LLC to corporation, or corporation to LLC, you get a new tax ID. The issue happens is that when you are already having, suppose 10 clients, where you have given your tax ID. Now you have to go back to them and say that, okay, now I have a new tax ID because I have a different, structure. And, all the bigger companies, they will take possibly 1 year, 18 months to even change those things, because for them, they don't care, right? But you care. Or at least.
As if it just takes away from your focus on business and the
So that's why I think, as Shridhar said very correctly, that it's very important to have a right structure and then go about it.
So these are good inputs, and I think, Sridhar, you talked about two very interesting areas. One was the founders or the co-founders agreement. But is it the same as the operating agreement, or is this a different type of agreement that you are referring to?
Yeah, so as I said, the names could be different. What matters is what is the content and the intent of drawing the document. To a larger extent, you can subsume the operating agreement, the founders agreement, into an operating agreement. But most of the times what happens is this operating agreement becomes a public document, or you need to share it with multiple people, and not at a stage where you need to make it open. So I would always recommend that between you and me, if I have something agreed, and which the world does not need to know at this point in time, I would have that as a separate document to be churned out, rather than putting into a document which goes to a government agency and all. This is strictly a private document between you and me as co-founders, and the world need to know. Any which ways, whenever there is funding happening, there are investors coming, this will go into a due diligence docket, and it will be available to them, but that's under strict confidentiality conditions.
Got it. So this is a private agreement, not necessarily a document that you have to submit to the government, but kind of lays the groundwork on how you and your co-founders will work together in the long run.
Yes.
Fantastic. So this is, I think, the points we talked about is really about how we set up a company, what are some of the key considerations, the state to incorporate type of company, agreements, and so on and so forth. But let's say once a entity is formed, it is set up, it's an operating business now. and your product, your revenue, that's where most of the co-founders are focused on. That's what they really want to get going. But at this stage, in your perspective, what are the key procedures the founder should prioritize and set up so that the back office is not really the focus area, but it's smooth and it doesn't restrict your business growth or scale?
So we always look at this. So we also run a business, right? So apart from being a professional, there is also a business angle to it, and we have identified over a period of time 2 or 3 metrics. One is the business works on three fundamentals. One is first the people, that is your people. Second is the processes, and the third thing is clients. So if I take care of my people so that they take care of the processes, the clients get taken care of automatically, is how we look at life at our organization at LegaLogic. What I mean by that is when it comes to people, and I'm not going to get into the deeper aspects of the HR and all, primarily what is your vision statement? And I'm not talking about those typical visions and missions. I am just talking about what is that you are conducting from your own actions, and what is that you are demonstrating and trying the people that you have engaged to mirror so that you get the desired results, right? So from that perspective, so you asked me a question, how do you manage so many clients? And there is a method in madness.
800 customers, 100 active customers. So that's a mind-boggling number, Shridhar. It is genuinely impressive on what you're doing. But yeah, I would love to know how you're.
And it's simply the process and its predictability. I was reading something today morning on LinkedIn, and it's a small anecdote, and it's a real one, where there is a picture of a tailor, and he is telling one of his customers how he took his advice seriously and how the business has grown. So the cartoon or the animation is such that it says that the tailor is sitting on his machine and is telling his customer that you will get the product tailor made next week on Wednesday at 4 o'clock. And then there is a conversation, and that conversation says that earlier, which tailor would have, of course, tailor is a good example to talk about. Which tailor would have committed you that you will get it at 4 p.m. next Wednesday? Predictability is the question. And this is exactly what. So today our clients, in fact, now they have got used to our processes so much that once you send an email, and if I don't send you an acknowledgement, they will within next 2 hours send a reverse email to us asking, have you received the email? They will not ask us whether you have attended to that email, right? So what I'm trying to say is build the ethos, build the culture in the organization in such a way that it demonstrates the intent of a co-founder. See, there will always be a difference between an owner and the person for whom you're working. And I'm not trying to say employee-employer relationship at all. That's not the point at all. It's all about what is going on in the mind. So when you try to make your people same as what you think, you have achieved 60 to 70% of the thing. And the rest comes is the processes to be followed, and then the business takes care of itself.
Fantastic. So if you take this analogy in the context of, let's say, legal, right? And usually when you are a small company, you obviously can't afford an expensive lawyer on day one, perhaps not in the first year, not the first 3 years. So for somebody who needs legal support for customer agreements, vendor agreements, disputes, what kind of legal system should companies set up as part of the whole process hardening that you are talking about? What does it mean in the context of legal processes?
Yes. So I will leave the dispute part aside because that has a lot of nuances, and I would not recommend anybody to take over the dispute resolution in their hand to the extent it needs to be. But as a founder, as a startup, just take care of 2 things. One is get your base documents reviewed from a lawyer one time. That is what we call as templates. Understand them as to what is the content and what is the intent of that document, and then use them to the hilt, right? And if there are going to be any changes, and what type of documents are we talking about? One is the customer facing document. Second is the confidentiality aspect, a very simple document. Third thing is your employee documentation. And the fourth thing is your vendor documentation. Most of the times you would want to subcontract, and that is what I mean by vendor contracts. If these 4 documents, if you have a template with you, drawn by a proper lawyer, and it does not take too much of a money. Take it from me. I'm doing it day in, day out. And then set the rules of those documents. How much should I vary from the templates, and what is the impact of that? If I have a rule book or a playbook with me, I don't need to go to the lawyers more than often unless it is outlier situation and when it is a dispute situation. Until that time, I think you will be very much within your control, because you know, and every founder knows what are the pitfalls, and he is the decision maker on the risk that he needs to take. So if you have those guardrails, if you have those documents, your 60 to 70% of the work is done. You don't need to go to the lawyers often than not, unless business gets complicated at a later point.
So segregate your legal contracts, templatize them, and then have guardrails around each of them, beyond which, if you need to, you can reach out to a lawyer. But otherwise, you basically have a repeatable process that you can use 95% of the time, maybe 90% of the time, right? That's fantastic. So Tanmay, maybe on the finance side, which is another, of course, the financial planning, forecasting, there's also the APAR, and then, there is other regulatory processes, compliance process. So what's the system you recommend for founders for finance?
Yeah, I think in addition what Shridhar is saying, I will be a little bit more micro, because finance and accounting is transaction based thing, right? So one needs to be a little bit micro. And I do tell to all my friends, all my the companies where I'm advising through ArightCo or even it at Winware where I work, I always say that for all kind of small companies, small and medium, what is your objective? Your objective is at some point of time to have an exit. So first thing is that have that objective very clear and think that tomorrow there is an exit. So how do you want to keep yourself ready for an exit if you get an offer tomorrow? So it starts with all the documents, like starts with the share agreement, option agreement. If you're issuing any options to any employee, get their signature. For employment contract, I still remember around 10 years or 15 years back, I was working for a company, and there's a very small company. Suddenly the CEO comes to me and says that this guy has applied for an IP. He has applied for an IP and it is similar to what we are developing, and he is working, he's an employee. So I said, okay, no problem. Well, let's see the employment contract. And interestingly, the employment contract didn't have any employment contract. It was just an offer, one-page offer letter. So, those kind of, now 15 years back also, now I think the US government also over a period of time has brought some rules, but 15 years, 20 years back, there were certain, such kind of things used to happen, and a lot of people actually didn't know. I feel that in the last 15, 20 years also, there has been a lot of education, even in US. I'm sure it's there in India also. So, those things, so you should have all your employment contracts in place. You should have all your vendor contract in place. You should have all your agreements in place. You should have all your, the compliances, like, every year you have to do certain state compliances, your tax return, your Delaware franchise tax return, everything should be there. Now, it is also a fact that because, finance accounting is a transactional services. So what happens is that if CEO has to do everything, then when CEO is going to develop product and when he's going to sell it. So that's also a reality, right? So we always say that, when a very small company comes to us, we tell them that, hey, can you do it yourself in Excel, or, we will give you we'll show you how to work in QuickBooks. Sometimes people do, sometimes people say, no, we can't do all these things. And, even if they do, possibly 6 months down the line, if they're doing well, they say that, so that time we say that, okay, what do you want? There are, maybe then subcontract some of the work to us, or ask some kind of companies, right? And there are, our kind of company every nook and corner in the country. So, but the point is that also as accountant, one must realize that what is the cash position of that company, how much is the transaction, because what I've seen is that these two areas, accounts, finance and legal, once they give it, and if we do a decent job, they don't even care much. They say that, okay, fine, I'm going to go and build my business, just manage it. So So that time, you do it, but you also understand that how your clients, purchasing power, how much, cash they have, how much is their cash runaway, etc. So we all know that as accountants. So, you charge like that. But the reality is that it's as the company grows. Now, if you don't grow, it's a different thing. But if you start growing, if you start taking people, if you start, start getting revenue, then it's a lot of work. And those transactional work, possibly it's better in my view to do some kind of at least outsourcing rather than, you do it yourself.
Yeah, because you don't need somebody full time, I suppose, most of the time, but you need the expertise that starts from, fractional CFO or a fractional chief legal officer
Exactly.
who knows how to solve complex problems. And then there are the daily transactions for which you need people who can do the AP, AR, or just MSA amendments and stuff like that. Right. So, yeah, I think that's exactly right. And I've seen that firsthand as well. So, we will switch topics a little bit. And I think one of you is in India, Shridhar, and Tanmoy, you are in the US. So, and I have seen companies and friends set up companies in India, in the US. So, while it has become easier to do business in India, there is a difference of opinion on if you are setting up an entity, should you make the US the parent subsidy? Should you make the India entity the parent subsidy? If you could talk about it both in the context of the pros and cons and on the finance side and the legal side, that will be great.
Yeah, I'll do that. Yes. Yeah, so that's a good point, Sameer. And we most often than not, especially from the founders from India, almost once in a week, we come across this question as to whether we should base out in India, whether we should base out of India. The one primary question that I ask to this question is, where do you see value? And where do you see the value getting generated? Where are you going to generate value? Is the first question that I ask. And maybe 5 years or 6 years back, the drift and the decision was very easy because people were moving out of India and basing their value outside India. But that is seeming to change now. But the premise on the basis of which this decision should be made is primarily the question that I ask is, where do you see value getting created? And that is where you should put your whole ownership structure and then decide the next steps accordingly. The other point.
So maybe I'll dive a little deeper into that. If you are a services company, you're delivering value to customers in, let's say, the US, EU, maybe East Asia. Where does a service company generate value? I can understand from a product company, maybe if your development team is in India. Is that what you mean? The dev team is in India, so the value creation is in India?
No, I think what I mean to say is the value is created primarily by revenue. And where is your customer? Be it product or be it services. In fact, what we have seen in the last few years, I would say, is that the services company are fetching bigger value in the M&A deals. Right. So from that aspect, so it's more about where the top line is concentrated on. So that will generate revenue.
So which geography is driving your revenue is your point when you say
Yes.
generating value. Okay, got it.
I think I'll add a little bit of, again, micro. What I've seen is that, micro aspect, what I've seen is that also, previously US used to be the hub of venture capitalists. And I'm talking about the smaller company, product companies as. But now I see that there are quite a few venture capitalists, either the US branch of, those folks, or Indian venture fund is coming up. And I have also seen sometime that, it's again an administrative issue. Sometimes I feel that, I have seen some of the US venture fund doesn't want to invest into an Indian company where the Indian company is the, parent. And it's a vice versa. Sometimes, Indian funds, I would feel that they are much more open, but still many times I have seen that they say that, okay, India should be the parent. So I think that also comes into a picture. But I agree with you, Shridhar. It's mainly the revenue which.
Yeah, so clients ask us as to, where is it easy from a compliance point of view or from a procedural point of view. I always tell them that, concentrate your time on the strategy rather than the processes. For the processes, there are many people to take care of it. And you should not worry about that, because then you're not doing business. Right? You're not in business, you're working in the business, not on the business. And over a period of time, I would say India has liberalized a lot from a structural point of view. US was always liberalized. Overseas, as compared to India, there are a few more compliances that you would find, and at times eccentric, and at times which is like a big question mark on the face as to why is this required to be reported. Right? There are certain rules and regulations. There are certain, and I always think on the policy based implementation of the law versus the code based implementation of the law. And if you go to the policy level thought process of the Indian regulators, you will understand where they are coming from. So if you understand that limited point, then everything becomes easy. And the biggest point is leave the compliance and the processes to the experts. You just concentrate on the business.
Got it. Got it. So focus on the business, get advice from experts who know how to do this, not only the basic architecture of your business, the setup of the operations, etc., but also let them manage or help you set up the structure for transactions. And then you go back to focusing on what you do best, which is build great products, build great services, and take it to market, acquire customers, generate revenue.
Right.
So what I've seen, and I've gone through it myself, is irrespective of where you incorporate the company, the parent, the subsidiary, there is always regulatory gotchas that come, right? A typical one in the US is state payroll taxes. It just happens, you have employees, you're going to get that every other quarter, so you not pay taxes, you're not registered, so on and so forth. So in your mind, what are those 3-4 things that one should keep an eye out for, watch out, so you don't get into a challenge later down the line?
From US perspective, that's great.
US and India, Tanmoy, so maybe you can talk about.
Yeah, I can wrap up about US maybe more, and Shridhar can talk about it. So I'll start with an example. So I was, Sameer, I think we discussed before also once. I was a fractional CFO of a company named Nexient. It was, sold the company when it was around $100 million revenue. So we were going through the M&A, financial due diligence was happening. And I was very happy that, the buyer got everything, whatever they wanted, we immediately gave it, etc., etc. And, financial due diligence was over. Then the legal due diligence was happening and SPA was being drafted. Suddenly I get a call one day on afternoon from my lawyer. And he said that they have given a point which we have to say that whether we are comply, which is whether you have got the license to do business in all the states where you are working or doing. I said, yeah, we have done it. Now we pay payroll, we do payroll in all these states, so we do it. I said, no. Even if you don't generate revenue, even if you have employees, you have to take separately, registration. You have to do registration with these states to do business. So that was a lesson for me. Obviously, we had to spend some money, etc. So I think in US at least I learn every day something or else. Now let me tell you what are the 4, 5, 6 things are very important. I'll start with tax, which is the most important thing, right? Federal tax, state tax, filing once a year, etc. You have a Delaware franchise tax. If you are a Delaware registered company, then you have, when you are doing payroll, you have to ensure that all your employees in all the states, they get registered. Some payroll platforms do that. Some payroll platforms do not do that. In those cases, you have to do that yourself. Then, you have to ensure that all the payroll taxes are paid. Generally, the payroll platforms pay automatically, but sometimes it doesn't get transmitted. So you will get a question, then you have to respond to that. There are certain other very important things which, which I must say that in US, there is a concept is sales tax. And sales and use tax, where you are in a product company or even SaaS, wherever you are selling the state, and depending on, so every state, unlike India, where it's India wise there is a GST, and the what kind of product commands what kind of rate of tax you have that. In US, every state has a different GST policy. So I'll give you an example. California does not levy any GST on a IT services company, but Connecticut does. So it's so much of difference. So like 50 states have different, and also every state has a certain revenue threshold. Some 100K, some 250K, some half a million. Beyond that, you have to pay. And then as your revenue grows in those states, you start with annualized tax return, and then it becomes even quarterly tax return. So it's a very interesting concept. It's a very broad. Sometimes I feel that, the authorities may not be also aware of everything and forget about us. So that is a very important thing that, when you are in product or SaaS business. And then also there is a concept called the GST will be levied where you are delivering the service, or rather which state is getting the benefit of that service. I'll give you an example again. Suppose you have a client A where you are invoicing to their corporate headquarters, which is in Nevada, but you are actually delivering a service where the New Jersey is getting a benefit. So technically then you have to see that in New Jersey whether you have a sales tax assessment or not. So those are also very important. And then what happens is that suppose you are buying certain things. Now some smaller vendors, what do? They don't register for sales tax in some of the states, or they don't go through that revenue threshold of $500,000, 250K or 100K, so they will not file sales tax. So, and if you are buying those products from those vendors where they have not charged you sales tax, it's incumbent for you to pay that sales tax to the state, which is called use tax. This is a very complicated and very detailed way you do it, and frankly there are not many inexpensive way of looking at it. I mean, everything is so complicated. So that is the other thing I must say, that one should really be careful. Other than that, I would say that as I told, that all the registration should be done, tax should be done, payroll tax return should be done, and this GST should be done. If this is happened, and then there are certain quirky regulation is there, like whether you can appoint a individual contractor in US. So there is certain rules, and if you are appointing, then what kind of tax form you have to give it to them. And there is something called W9. If it is an international individual vendor, then it is called W8 Ben, which is a benefit, we call it. Also for when you are taking an employee, like your employee and employee, there is certain things as per labor law, you need to see that. We call it I-9 verification, right? That the person is a US citizen, that he has to give those citizenship proof if there is a permanent resident or visas, all those proofs that has to be done. So these are the whole gamut of thing needs to be done. But for a small company, I guess what I'm telling, they need possibly 5 or 10%. But as they grow, all these things will come into picture.
Correct. And you never know what comes and hits you later on. So it's better to be covered on all these items as you grow, right? What do you think, Sridhar, in India? Is it similar?
Yeah.
Same chain?
Yeah. So the principally, see, if you are looking out for what you call as a liquidity event at a later point in time, it all depends upon how much you have been into the business and how long you have been into the business. We believe that anything more than 5 years as a business existence would need at least 1 year to 1.5 years for us to help you be ready for the liquidity event. And what I mean by that is just echoing what Tanmoy said, is to see if all the processes, all the compliances, all the paperwork, right up to a small SOW, because that's what gets into the diligence, that if you're ready or not. And believe me, we are helping a few for going to IPO, and we are starting to prepare 3 years ahead. It's that time frame that we are looking at, because it's not going to be easy. And definitely a company which wants to go for an IPO would not be 2-year or 3-year-old company. It would be at least a 15 years old company. So having said that, it's very important that you are ready. And if you start small and if you are organized, I would start creating my data bank from day one, structuring the whole data room in such a way that tomorrow, and by the way, this is not vendor due diligence. I am saying I am doing it on my own. And if there is any kind of a vendor due diligence that happens, I'll just simply throw a link to you and say that, okay, check what you want to have, what you want to check. So that's the readiness that should happen, because laws are complicated.
That's, you're referring to that what is called the data room these days,
Yes.
where you can upload all your documents, open them for any company that you signed up.
Yeah, I can give you a very small example. And also planning. Planning is very important. And I'll give you a very small example of how we were exposed to how a cap table was messed up because of So this is and nothing against anybody. He was a consultant, was helping get some funding for the company, and in the process of restating the balance sheet, there were a lot of profits in the balance sheet. So he said, let's capitalize this and let us issue bonus shares to all the founders. So this is a 15-year-old company, and they are looking out for funding, and most of the not funding, I would say, and an M&A deal. So they would be selling out their stake in the company. And day one, so there are shares which are held by them for 15 years. Day two, equal amount of shares which are issued on day two, which is in the form of bonus. And in 3 months, they are wanting to do a deal, and the entire 100% stake sale. So what happens is 50% of the shares are having the capital gain benefit, but the 50% of the shares are not having the capital gain benefit. So then the client comes to us and asks, what do we do? I said, boss, you have already done something. Now you cannot go at least wait for 1 year to happen to have the deal, so that you get the benefit of the long-term capital. But deals do not wait like this, right? So it is very important that when you take certain structural decisions, and if you have a horizon of M&A or a funding round, then you need to be very careful about each and every step that you take. What is the impact of it in the next 1 year or 2 years is something that needs to be thought over very carefully.
So this is like getting ready for a Swayamvar.
Yes.
So you have to do the data room, go through, audit yourself internally, both on legal, regulatory, financial side. So when outsiders come in and check you, everything looks complete and good to tie the knot. Tanmoy, you want to say something?
No, I mean, just to add, even what kind of transaction you are doing when you are exiting, whether it's a stock sale or asset sale.
Correct.
Because in US, asset sale has a much more tax incidence than a stock sale.
Yes.
So that's again a big thing, right? You're a small company, someone says that I will do an asset purchase, you don't have to worry this, that. And you say that yes, and then, when you go back to your CPA or CIA, they say, no, you have $1 million tax liability. And then actually it's happening as we talk today with one of my,
And in this situation, basically you spend 4, 5, 6 years building the company, but at the end of it, you can't get the right value because you miss something very fundamental and perhaps something very, very small that could have been fixed much easily.
Yeah.
So this is very, very interesting. So, we probably need to end for today. We'll have a follow-up session shortly. But one small question for you, and there's a lot of tool sets in the market now, but from a legal, financial, payroll, etc. standpoint, what are the 2, 3, 4 tools that you think every founder should have? They should set up so life is easier for them as they scale.
Yeah, so
I can go first and then Shridhar, and so very quickly I will tell about the other basic stuff. So in US, you should have, in my view, you should have at least a financial platform. Whether it is QuickBooks, whether it is Zoho, whether it is Zero, it depends on you. But you should have. And frankly, there are different products for which different financial platforms are also available. Like in US, there is a very large, business which is non-profit. I'm not a business, but activity, which is a non-profit sector. They have a completely different accounting platform than for-profit, right? So that thing is there. Then you should have, I think, definitely, you should not do payroll yourself. In India, possibly one can do, but in US, there are so much of, complications. You should use a platform. Initially, you should go for a very simple platform like, Gusto or Intuit, etc. So the cheaper platform. As you grow, you should have a AP tool, at least, which is, there are Bill.com or there are Ramp, all those tools are there where you can go through your whole, your invoicing, your vendor contract, vendor invoice, everything is automated and, it gets thing. And then, obviously, for a long time, you can do your metrics and everything on Excel. But as you grow older, there are other accounting tools, right? In NetSuite or Intact or similar kind of tool that you can use mainly for SaaS and product companies. Again, there are other tools like timesheet system, very important for at least services industry, extremely important. So you can do that for, cap table. There are now enough tools available in the market. Initially, I think small company, one can do it in Excel, but as you grow, obviously you need that. Yeah. So those are the basic tools. It's not that you have to do it on day one. you do it, over a period of time.
Yeah, I echo Tanmoy's views. I would make only one statement is go for automation. Wherever and whatever is possible, there are many tools available. And right from, I would say, order to cash is and in between the whole journey of your organization, you need to have something which is automated. Of course, everything works on manual data input, but once it is input, it should be required to be input only once and not multiple times. That reduces the fatigue. And the second thing, one of our clients who is a data scientist, and I was trying to work with him on something, he said, Sridhar, bring all the data at one place. Don't keep it at multiple places. You will be able to analyze it better. So that is more from the data analysis point of view. But from a compliance point of view, yes, in India as well, the trend is that the payrolls are not handled internally unless you have a robust team. You always depend upon someone who is specialized in doing only that. And of course, with the help, the days are gone where everything is maintained on spreadsheets. They have become intelligent spreadsheets now, and you get all the insights at one place at a click of a button. Whatever tools you choose, it is up to you, because it is all dependent upon how complex, how much cost effective, and so on and so forth. But automation is the key today. You have to ensure that you are on some of the other automation tool.
Thanks a ton for your time today, and we look forward to catching up again.
Thanks.
Thank you.
So that was an incredibly insightful conversation and a very exciting chat. Thank you, Tanmoy and Shridhar, for sharing your deep expertise, experiences as both advisors and entrepreneurs. For anyone building a digital business today, our session today was a masterclass in laying the financial and legal groundwork for scalable growth. If there's one big takeaway from this discussion, it's this: don't wait for things to break. Get your structures in place early. The right frameworks not only keep you compliant, but they give you clarity, confidence, and readiness. Whether you're hiring your next team, raising capital, or preparing for an acquisition. So, for financial planning, CFO services, please reach out to Tanmoy. His company's website is www.ArightCo.com. You will see it flashing on the screen. For legal frameworks, agreements, and advice, reach out to Shridhar's team. Their company website, you should also see it flashing on the screen right now. That is www.LegaLogic.com. Remember, Wai is your engineering partner for product design and development. For more information about our services, you can reach us at reach@wain.com. If you enjoyed this episode, please share it with a fellow founder, and don't forget to subscribe to the Wai Involve podcast. We help digital businesses grow stronger, faster, and smarter. So until next time, stay curious, stay structured, and stay ready to scale. Stay tuned and stay connected with us through our Wai Involve community on LinkedIn. Thank you.